Alright, welcome to our weekly update on the Australian property market, where we discuss waves, impulsive waves and corrective waves around Australia. I thought I'll give you a quick update on the local housing market while having a break from the European tour around the property markets. I have a whole bunch of charts prepared for you to crunch, so if you like this content, give it a thumbs up and subscribe to the channel. As the US 10-year bond yields are going through the final stages of the major Wave 1, we should expect a reversal both in yields, but also in the US dollar index. That means sugar for all markets, including housing. As usual, the MSM does not provide a full picture in reporting the current situation in the market. Just by reading the article, you'd think that we are starting a major downturn in Byron Bay. For example, this AFR article states that Byron Bay has dropped 7% over the past 3 months. And the justification behind the drops? A combination of higher supply and less demand in place is probably fueling a larger than average adjustment in home values in the regions compared to the capital cities. That's fair enough, but listen to this. Unfortunately, summer comes with a lot of headwinds for the regions, with increasing extreme weather events like bushfires and flooding, which I think some of these original markets are going to see in the coming months. End of quote. Well, guess what the chart of the day is going to be about today? The quiet fishing village of Byron Bay, 2481. Just as I mentioned in the episode titled Postcode Analysis Bondi 2095 from July 2023, the ritzy postcodes of New South Wales are going through the fourth wave, which is a correction before the final wave up. Indeed, the price is slumped as a narrow section of the chart indicates. But guess what's coming next? Before we get there, let's bring back a broader picture and the historic chart of Byron Bay. Here's Wave 1, Wave 2, Wave 3, Wave 4, and a final fifth wave. Currently, we have started the third wave of the final fifth wave. Wave 1, Wave 2, Wave 3. It's only a beginning, which means we are about to experience some huge gains over the next few weeks. So the article was referring to a sliver of a chart that in my opinion was going through a second wave of that very third wave. Hence, if you sold a property as a result of this article, you'd miss out on the incoming wave of liquidity generously provided by the local subsidiary of the Bank for International Settlements. So what should we expect in the coming months? A huge spike corresponding to the third wave, which is the most potent out of all of them, followed by a correction, one more tiny spike, then a bigger correction, and another more prominent spike that is made of smaller peaks. This will end up the whole 50-year cycle. The writing is on the wall. No matter what the government does, it may try to prolong the process of reaching the peak or slow down the descent from the peak. But we won't be able to pierce through and start a new wave 6, 7 and 8. What's coming after, you may ask? A slow decline that will last for decades, as is currently taking place in Japan, Korea, Italy and Spain. Check out the part 1 of the Global House of Cards series to see how they blew up. Interest rates are about to get slashed, or at least put on hold, as the US bond yields are on the verge of hitting the brakes, reaching final fifth wave of the bigger Wave 5. That means more sugar for this drug addict called the real estate market. Perhaps some celebrity is going to see this video and jump on the gravy train before it explodes up. It's going to be a short-lived spike up, as we are already in the middle of the final Wave 5. Wait for more updates on this volatile market. Meanwhile, stay calm and count waves.